Hi, I'm Alan Hovis. I'm a real estate broker, contractor, and property and casualty insurance agent here in Florida. We've put this channel together for you to answer your questions about buying and selling real estate here in Florida. If you've got additional questions you haven't found answers yet to, just put them in the comments below and we will get back to you. Or maybe we'll make a show about them. Thank you for watching.
Today we are speaking with one of the premier mortgage brokers in the Sarasota Bradenton area, but he's licensed for and can practice in the entire state of Florida. I have worked with Sean Martin for a good 15 years and can personally attest to his knowledge and professionalism. That is why I chose Sean to do this mortgage series. So let's ask Sean all of the questions we usually hear when working with buyers. Sean, thank you again for helping us with all of these questions. So one thing that I see a lot of is people who are getting their first mortgage or people who have not had the experience of getting a mortgage for a long time have questions about the terminology and the acronyms. So if I can ask you about those. First of all, what is LTV?
Yeah, that's one of my favorite terms, and that's referring to loan to value, which is basically the relationship the borrower has with, okay, this is the purchase price, and let's call it $100,000, and this is the down payment. So 20%, that would be an 80% LTV. And so some people are putting down a significant amount of money and getting a very small loan, in which case they have a very low LTV. And then some people are looking for as little down as they can, in which case maybe they go to an FHA loan and get a 3.5% down payment program, and so they're getting a 96.5 LTV.
Okay, and tell me about PMI. I know a lot of people get told to stay away from it. What's your thoughts?
Yeah, so PMI, private mortgage insurance, not as bad as the general public might think. A little background on that. So private mortgage insurance is basically insurance that protects the lender in the case of default. Some would argue that it's also protecting the consumer or the borrower, because it's in the event of default, it covers a percentage of any loss that you might have, and therefore if a house were to go to foreclosure, maybe it lessens the amount that you have in that situation if things went the wrong way. But let me tell you the good thing about PMI or private mortgage insurance. It lowers the interest rate, typically lowers the interest rate for the average borrower. And you're going to say, why? Why is that? Because it represents to the lender additional monies down. So in other words, somebody that comes to borrow a home and they put down 20% does not have to pay mortgage insurance, private mortgage insurance. However, somebody that comes to the bank and they put down 10% is often going to pay private mortgage insurance. It's a monthly payment that's added to your mortgage. And in that scenario, their interest rate is lowered because it could be lowered because it represents additional monies down. The insurance represents more of a down payment to the lender, and therefore they get a slightly better interest rate. So don't think about it as all bad. Sometimes the amount you save in the interest savings is enough to cover the additional PMI payment. So it's not a bad thing, but I would compare all scenarios. I'd compare the 20% down with the other options that are available to you.
Okay, thank you. And Fannie and Freddie, who are these people? What do they do?
So Fannie and Freddie are these, we call them GSEs, government-sponsored entities. They provided a backdrop for the U.S. housing market to be able to provide money for people to buy houses. In a nutshell, Fannie and Freddie basically were the only option when banks wouldn't step up to the table because of economic crisis, the depression. Banks weren't willing to lend money on a housing market that they were afraid would default. And so they provided a backstop to consumers that needed to find a way to create a housing market and be able to sell houses and finance houses. The majority of loan programs that I'm involved with utilize some variation of Fannie Mae and Freddie Mac guidelines in their underwriting. Whether it's the way they perceive income, whether it's the way they perceive assets, they basically set the guidelines for how underwriters review information in a loan file.
Okay, at closing, when we're at the table going over numbers, my clients often have a question because the interest rate that they negotiated with and received from their mortgage broker is one number, and then there's this other number on the closing statement that says APR. Tell me about this.
Yeah, so that's a tricky one because people get confused on the difference between your interest rate, which is the amount you're paying to borrow the money, and the APR, which is the disclosure rate. And the way that works is the APR is calculated by adding up all of the interest that you pay were you to make every payment on that loan over whatever term it is, whether it's a 15-year term, a 20-year term, 30-year term. At the end of the term, they take every amount of interest that you've paid. They add to that any other fees that would be considered essential for obtaining the loan. Some of these fees are nothing to do with the lender themselves. They could just be a closing fee that the title agent charges you to close the loan. Some of them could be the bank's underwriting fee. Any of these nominal fees that were on your closing statement that are added in as part of the closing get added to all of the interest that you paid over the course of that 20 or 30-year loan. And that's why at the end of that term, the APR is generally slightly higher than the actual rate. Now, it is important to note, the closer the APR is to the interest rate is in most cases the better for the client, because it means you're not being charged a whole bunch of additional fees at the closing.
Okay, speaking of fees, let's talk about points versus origination fees. Can you explain that?
Absolutely. So most origination fees can be two different things. There are fees that the lender just charges as a matter of process. Banks, believe it or not, incur costs to originate home loans, whether it's their software provider, their storage provider, their technology fees, whatever those are. So banks typically try to collect a piece of those fees when they go to closing. Usually it's somewhere between $1,000 and $2,000, depending on the individual lender. Those are considered origination charges. They're different than paying points in the form of discount points that are paid deliberately to lower the cost of the mortgage. In other words, you're buying the rate down by paying additional fees. The way that typically works is there's no exact science to it, because different programs can be priced differently, but usually you pay a 1% fee or a 0.5% fee, and what happens is the interest rate on your mortgage goes down by some nominal amount. A good number is 1% will typically buy you a quarter in a lower interest rate. I've seen all different variations of that. Generally speaking, there's a little bit of a run time on getting your money back, and it's just a matter of having the loan originator tell you what the break even is and if it's a good deal or not for you.
Hey, Sean, thank you so much for all of this mortgage information. It's going to help a lot of people. And can I come back sometime and maybe ask you some more questions as I receive them?
Absolutely. I'm always happy to answer questions.
Great.
Thanks, Alan.
Thank you.
Hopefully the content in today's video has helped you answer some questions. If so, please like and subscribe. It helps us keep the channel going and answering all of your questions. Now, I work in the Sarasota Bradenton market, but we have referrals for agents all over the state of Florida. My contact information is below and in my website, alanhovis.com. And if you are a Florida real estate agent, please contact us if you'd like to be on our referral list. That's it for now. We'll see you in the next video.